Hey guys, what's up? It's Mike. You got me in the office now. So we've left the gym and we're coming into the office and we're going to be talking about how to understand your money. Money is a gift from God. And so often people abuse money. We view ourselves as the owners of our money rather than the stewards of the money that God has given to us to use to glorify His holy name. Now, you know, the Bible has a ton to say about how to steward money, and you're going to be learning a whole lot of that in your homework and through the different life skills classes that you've got coming up. But today we're going to talk about how to understand cash flow. Cash flow. And there's two things on your homework that you're going to be reading here that in order to take control of your finances, you absolutely have to understand. Number one, you have to understand how the money is flowing into your life and how it's flowing out of your life. And number two, you must understand the importance of a budget and how to create one. And guess what? We're going to teach you how to do those two fundamental things in your life skills module coming up. So today, we're talking all about cash flow, all right? Now, there's a couple of terms that in order to even have an informed discussion about cash flow, we have to first understand. Number one, there's a term called a financial statement. Now, I know you all listening are at different levels of your financial intelligence, but a financial statement consists of three different documents. Number one, it consists of the income statement, which is just a record of your income and your expenses. Number two, a financial statement consists of your balance sheet, which is just a record of your assets and your liabilities. And we're going to define those two terms in just a moment. And the third portion of a financial statement is what's known as the statement of cash flow. And this is just a record of the movement of money in and out of your life. Some accountants and financial teachers describe the statement of cash flow as recording the relationship between the income statement and the balance sheet. And we're going to see that today. But why the financial statement is important for you to get into your mind is because we're going to be referencing the financial statement throughout the next couple of videos. Then there's 6 key words that you also need to really memorize in order to become financially literate and to become financially intelligent. And these 6 words are income, expense, asset, liability, and cash flow. Now, income is just the money that comes into your pocket, right? No one has any problem understanding what that means, right? So income is the money coming into your pocket. That's how I want you to think about it. The expense is money going out of your pocket. An asset is anything that puts money into your pocket. Okay, so an asset is something that generates cash that is then coming into your life and recorded as income. A liability is the opposite of an asset. It's something that takes money out of your life. It's something that you own that takes money out of your life. And we're going to talk more extensively about assets and liabilities later on. And then finally, cash flow is the movement of money between, like I said earlier, the income statement and the balance sheet. So let's get into understanding the financial statements. All right, so now that we've got our financial statements on the board behind me, and now that you can see this example right here, you guys are going to learn the relationship of cash flow between the financial statements. Now, just to give credit where credit is due, this diagram I did not come up with. I first saw it in a book called Rich Dad, Poor Dad, written by a man named Robert Kiyosaki. And really that book helped me to understand something that I had previously thought was just, not able to even be understood. And so the reason why I'm using this is because it benefited me so much, and I hope that no matter where you're at in terms of your financial position, this will benefit you as well. It'll help you conceptualize how the money flows into your life and how it's flowing out. Because again, God requires us to be good stewards and managers of the wealth that He has chosen to give us. And even more than that, He's given us ways to create more wealth. wealth. And that's something that I want to speak to really quickly. And it's unfortunate that there is a version of so-called Christianity out there called the prosperity gospel that falsely teaches that Jesus wants you to become healthy, wealthy, and wise. That's not what the Nehemiah Project adheres to. We do not believe that just because you become a Christian that you will de facto become a wealthy person, materially speaking. That is not what the Bible teaches. However, what the Bible does teach is that we are to be good stewards of the resources that God has given to us. And furthermore, because we've been made in the image of God Himself, we have the ability to be quite rational, to be very intelligent. All it takes is a good stewardship of our time and really just being willing to work hard and learning new concepts. And so I want to read just briefly from Deuteronomy chapter 8, verses 17 and 18, just to show you that being rich or being wealthy or even growing in your wealth is in no way, shape, or form a sinful thing in and of itself. There were plenty of very wealthy believers all throughout history. Abraham comes to my mind. He was extremely wealthy. Job, very wealthy. These were men who were faithful believers in God. And so, again, Deuteronomy chapter 8, verses 17 through 18, this is the Lord speaking through His prophet Moses about the future spiritual condition of His people Israel. And listen to this. Beware lest you say in your heart that my power and the might of my hand have gotten me this wealth. But you shall remember that it was the Lord your God who gave you the power to get wealth. Or even some translations say, gave you the power to create wealth. And so that is a very important principle to remember before we even start talking about different financial positions. The Lord Himself has given us, as His image bearers, the ability to create wealth. Like I said, we have to invest in our financial intelligence, in our financial education, and then we got to put principles to practice that the Lord clearly lays out in His Word. And so that's what we're going to learn about how to do. But first, I want you to notice there's three basic financial positions for our discussions today. You have someone who would be in a poor financial position, someone who would be in a middle class financial position, and someone who would be considered in a wealthy financial position. And let me just give you a brief description from your homework about some of the characteristics of all these people. Number one, somebody who's in a poor financial position is potentially a hardworking individual who earns an income through a job or receives income from maybe government welfare or disability or some other means. However, they primarily spend their earned income on what we're going to refer to as fixed expenses and consumption. Now, fixed expenses, remember, expenses are the money that comes out of your pocket. Fixed expenses are things like rent, your car payment, childcare, etc. And generally, they make up a large portion of a person who's in a financial position that is poor. Those types of expenses make up a large portion of their total income, more than 90% usually. And then whatever money they have left over, generally they'll go out and consume. They'll spend on things that they don't necessarily need, but that they'd like to have. And as far as their investing is concerned, they usually don't have enough money to even invest money at all. Or they'll have investments that they think are assets, but actually are more like liabilities. So therefore, the principle that I want you to remember, that you're going to hear me say over and over again, is that someone who's in a poor financial position does not invest any of their earned income into cash flow producing assets. And they generally have no desire to invest in their financial education. So let's give you just a brief summary of what I just said here on the board, okay? So we're going to call this person Mike, because that's my name, and I hope I don't offend anyone whose name is Mike. Mike is in a poor financial position, okay? Again, this is not a judgment on his character or anything like that. It just is referring to his bank account. Okay, so Mike has a job or maybe welfare, and that's where his money is coming from, okay? So his money flows into his life and is recorded on the income statement of that person's financial documents as income. Let's say he makes $2,000, and that's recorded as income on the income statement. But because Mike's fixed expenses take up a large portion of his income, he doesn't have a whole lot of money to invest. So that money, rather than flowing to the balance sheet, going into the asset column, is likely going to go to the liability side if it even makes it onto the balance sheet. But most of that capital is just going to go straight into expenses. So it'd flow down here where the expenses are recorded as rent. Remember, he doesn't own a house yet. He's just been renting. They're recorded as car note, right? If he has a car. If he doesn't have a car and he takes the bus or some other means of transport, he's going to have expenses surrounding that. Furthermore, Mike's got to eat. Mike's definitely got to eat. This Mike's always hungry. So we got to have a grocery budget. All right. And then he's got to wear clothes. So we got to have a clothing budget, etc., etc. You guys get the point. There's going to be, along with the rent, there's going to be different expenses. So we'll just put miscellaneous expenses. Okay. So you guys can see how the majority of Mike's income is getting burned up. Let's say his rent is $1,200 a month. Let's say his car note is $300 a month. That's $1,500. Then he's only going to have about $300 a month to eat there. That's $1,800. Then we'll go $100 to clothing and $100 to miscellaneous. By the time all of Mike's expenses are accounted for, he's got no money, and it just walks out of his life. The money that flowed into his life from his job, his welfare, never crossed over onto the balance sheet. That's one scenario of someone who is in a poor financial position. He never had the opportunity to invest in cash flow producing assets that will produce money for him whether or not he works. That's one scenario. Then let's do one more scenario. Let's say that Mike is a little bit more concerned about his future and says, you know what? I really don't need to spend so much money on clothing, so I'm just going to allocate, let's say, $50 to my clothing budget, and my walking around money, my miscellaneous expenses, I'm going to cut that in half. So his rent is $1,200, his car note's $300, his grocery budget's the same, that's $300, that's $1,800 total. Then he allocates $100 to clothing and miscellaneous, which leaves him with $100 left over to do something with. Well, let's say that Mike is going to invest a little bit. That would take him into another category, which would slowly start to bring him into middle class, but we'll talk about that in a moment. But let's say he just wants to invest a little bit of money, I don't know, in a Robinhood account or something. Well, because Mike increased his financial education, he can now allocate that money over here in the asset column. And now, even though he doesn't have a ton of money to invest, he's starting to think about his future. Mike is tired of being in this poor financial position, and he's decided to do something about it. Well, that's one scenario where Mike can start to climb out of this category and get up into the middle class category, which is what we're going to talk about next. Okay, so Mike has decided to get out of that category of being in a poor financial position, and he started to allocate enough money to where he can finally put a down payment on a house. And so that's what he's doing. He said, you know what, that Robinhood account was great, but man, I'm tired of paying rent. So instead of investing money in that Robinhood account, he started to save that extra $100, and he started to even save a little bit more here and there until he could finally put enough money for a down payment on his own house. And therefore, he's now in a new position, because someone who's in a middle class position for purposes of our discussion has a similar cash flow pattern to someone who's poor, except they earn a little bit more income primarily through a salary. And so one of the ways that Mike was able to begin to save enough to get that down payment was he said, you know what, I'm actually tired of making this much money. $2,000 a month wasn't really leaving me a whole lot of money to save for my future. So he started to work on his resume. He started to get out there and look for a new job that would pay him a little bit more. he realized he may have had to go back to school in order to get qualified to get a higher paying job. So he did all those things that were necessary, and now he's able to finally put that money that he saved down on a down payment on a house. And he's got a new job. Middle-class individuals here in this financial position, generally speaking, have a different type of income situation, and primarily they usually have a salary, okay? A salary. Difference between an hourly employee and a salaried employee is that a salary employee basically has a fixed amount of money that they can make, whether or not they work 80 hours a week or 40 hours a week. And so Mike is making the majority of his income through his salary. He's off government welfare, he's off disability, he ditched the hourly job, and now he's making a little bit more money. So middle-class individuals, like I said, they have a similar cash flow pattern as poor individuals, except they also spend the majority of their earned income on fixed expenses and consumption, but they purchase liabilities that they believe are assets, and I'm going to explain that in just a little bit more. As far as investing is concerned, they typically only invest in retirement-related assets, which cannot be used, unfortunately, without penalties until retirement age. You guys have heard of these things. They're called 401ks, they're called Roth IRAs, etc., etc. Those are investments, but you can't tap into those investments until you reach retirement age unless you want to pay a pretty hefty penalty. So the last thing I'll say about these middle-class individuals is they typically do not invest much money into cash flow producing assets, and most of the time they generally have no desire to increase their financial education. And so let's look at what their cash flow pattern might look like. So Mike has a salary now, and let's say that he's making $60,000 a year, which comes out to about $5,000 a month. Of course, this is obviously not considering taxes, but just to keep the math simple, let's say he brings in $5,000 a month. So that money from his salary comes in, it's recorded on the income statement as income, and now, because he's middle class, he owns some assets. Well, really, he owns some liabilities that he thinks are assets, and I'll explain that in just a moment. So the money flows onto the income statement, and it comes over here where it's going to meet his first liability, which is the house. Now, remember what our definition of a liability was? Something that takes money out of your pocket. A house takes money out of your pocket if you're living in it. It does not put money into your pocket. Now, I know that the house does appreciate in value, but that only matters if you sell it. So for our definition, a house is going to be considered a liability, although something that you need. So his mortgage note is the first expense that he's got to take care of, and that's going to be recorded over here as an expense, and let's say that his mortgage is $2,500 a month. Okay, the next liability that it reaches, he bought himself a new car or a truck even, let's say. Okay, so he's going to have a car note associated with that, and that's recorded over here on the income statement, and let's say that his car note is $500 a month. And you know what? Mike likes to go fishing, and in order to go fishing, you know what you need? You need a boat. So he's got himself a boat note. Oh yeah, the debt is racking up quick here, Mike. So we have a boat note. Let's say the boat note is, I don't know, $700 a month. So far, we're looking at a total expenditure of $3,700 a month. Now, Mike's got to eat, Mike's got to clothe himself, Mike's got to take care of all the other expenses of his life. So he's going to have grocery, he's going to have miscellaneous, etc., etc. So Mike eats a little bit more because he's been working out in the gym, so he's going to go 500 instead of 300. And then the rest of his money, let's say that he spends, I don't know, $500 on himself, just going out to eat, walking around, likes to have a good time. So now Mike is at $4,700 a month. Now that only leaves him with $300 left to save. or left to fix his boat that broke down, right? Or do something. So let's say he has an emergency fund, which we're going to talk about later. Okay, so all of his capital now has been spoken for. His $5,000 a month has been spoken for, and none of this cash ever crossed the asset column, right? So Mike is no longer able to invest in cash flow producing assets. Maybe he's investing in that 401k that I told you about, but the problem is he can't access any of that capital unless he wants to pay a huge penalty. So this is what the cash flow pattern of most middle class individuals looks like in a very general way. Now let's look at the wealthy cash flow pattern. Okay, so we've looked at the poor financial position, we've looked at the middle class financial position, and now we're going to see what the cash flow pattern of someone who is considered wealthy looks like. Now before we get there, let me just read a couple of the notes off of y'all's homework. Somebody who is wealthy has a very different cash flow pattern from the poor and middle class. A majority of their income is generated through cash flow producing assets. That is the primary difference. I'll say that one more time. A majority of a wealthy person's income is generated through cash flow producing assets. In other words, most of their money is generated out of this column. That's why it's very different than the poor and middle class financial position. Furthermore, after paying all of their fixed expenses, they generally reinvest the excess cash into their cash flow producing assets. Because they are financially intelligent and typically financially literate, they do not purchase liabilities that they think are assets. Due to their financial intelligence, they also turn their liabilities into assets, and we'll talk about that in just a moment. As their assets increase, so do their income. Wealthy individuals have many ways also to reduce their tax burden because the majority of their income does not come from a job or salary. Again, it comes from cash flow producing assets. Furthermore, they also make it a point to seek out the best tax planning professionals in order to minimize their taxes and expenses. And by doing this, they further increase their income, which is then reinvested into more cash flow producing assets. Thus, the rich get richer. Now, Mike is doing pretty good in the world. You know, he kind of figured out that not really investing any money at all in something that he can immediately tap into wasn't the smartest thing. And so he started looking at his budget and he started going, you know what? I don't really need to have this boat, this car note, and all those things right now. I could really just take a lot of that money, pay down the debt of my house, and then I can take all of that extra money and start to invest it in businesses, in stocks, in bonds, etc. And that way I can start to get some cash flow producing assets to really generate some extraordinary income for myself. So he still has a salary, but let's say Mike really invested in his financial education and said, you know what? I want to start a business. And so he went down that path. So his salary comes from the fact that he is a CEO or some sort of owner of a business, okay? And let's say that he's making, I don't know, $120,000 a year off of that salary. Now, Mike again has doubled his income. This is done all the time in America. And Mike is really taking advantage of the fact that this country allows us to do these things. So, Mike is doing very well at this point financially. And furthermore, he's also getting money from another couple of streams. He's got stocks that pay dividends. He's got some bonds in his portfolio. He's got real estate. Let's say that he's also got some businesses that he has helped a friend start in which he has a ownership interest, and he receives some money from that as well. He invested in his financial intelligence, and so he understands that there's more ways to make money other than your salary. And so he's making money while he sleeps on all of these things. And let's say that his assets are producing for him another $100,000 on an annual basis. Okay, now he lives off this money, the money that comes in here, is recorded on his income statement as $100,000 from his assets, which, by the way, these are taxed differently than your income that you make from your salary. And this $100,000 is going to meet his $120,000 from his salary. So now Mike is making $220,000, 50% roughly of which he doesn't have to actually do anything for. I mean, yes, he maybe has to manage some of his real estate and maybe do a little bit of business management, but not much because he doesn't have a majority ownership stake in those businesses. So really, this is what we call passive income. Now, all of this capital here is going to go down to meet his expenses, which some of them could stem from liabilities that he has, and we'll talk about that in just a moment. But let's say on an annual basis, his expenses are $100,000. Okay? Well, that leaves him with a $120,000 profit at the end of the year, which, you know what he does? In turn, he reinvests it in his stocks, in his bonds, in his real estate, and his businesses. And what this does is it compounds the gains that he can make from his assets that produce cash flow. You see how this is the system that helps the rich get richer? Now, let me show you one more scenario here for a wealthy person. Okay, so again, Mike has stocks that pay dividends, he's got some bonds, he's got some real estate, and he's got some other business ownership interests. Okay? Now, we talked about how he's got the salary, he's got $100K coming in from these things. But let's say that he owns a large piece of property that he also lives on. Okay, so he's going to have a mortgage associated with that. But let's say he's got 20 acres. He's got 20 acres. Now, because he's got some financial intelligence, he goes, well, I could use 19 acres of that 20 acres to make me some money so that I don't have to pay for the note that I've got on these 20 acres. So what does he do? He goes and builds 3 houses on it. So he's going to invest some of his money that he had left over. Remember, we said this money was coming over here. It meets his salary, $120,000 plus $100K equals this. It came down on the expenses. He lives very frugally even though he makes a lot of money. And that left him $120K every year in profit to invest. He saved his money up for 3 years. Now he's going to take this capital and he's going to invest it in this 20 acres and he's going to build 3 houses on it. Let's say that his mortgage note is $15,000 a month for that 20 acres. Yeah, he don't want to pay that every month. That's why he's doing this. So he builds 3 houses on it and he's going to charge the tenants rent, and each one of those tenants is going to pay, let's say, $5,000. So every month he's got 3 tenants times $5,000, which is a profit, or a revenue I should say, of $15,000. Therefore, Mike gets to live on his property without paying any rent himself, or any mortgage, I should say, himself, because the tenants are now taking care of his $15,000 a month mortgage note. The point in me showing you these different scenarios is that when you invest in cash flow producing assets and you do the journey that Mike did, coming from the poor financial position, not feeling self-pity, not saying, well, I guess I'm just never going to make it out of here, but doing the work that it takes through investing in his financial education, through understanding that he's a steward and not an owner of anything, that God gives him all things, he realizes, man, I could get out of this position, and that's what he's done. And he realized he needs to be able to make money as he sleeps. And he invested in that idea for 10 plus years. And he got himself to the point where he had some real investable capital to start investing in cash flow producing assets and also to not have to pay a mortgage. So I hope that this has helped you just visualize the difference of cash flow between these three financial positions. Even though it seems hard, it's not impossible. You can do it.